Hello traders and welcome to a new video on anti-fragile trading. There has been so much going on recently with Bitcoin that I thought it would have been a really good idea for me to show you guys something that I've been preparing with fragile versus anti-fragile trading. What I can promise is if you watch the end of this video, you're going to have a really good understanding of what types of trading are going to lead to profit, money, happiness, and what types of trading are going to lead to the loss of your account. Let's go over all the types. Okay, so first of all, what do I mean by anti-fragile? It comes from a book, this book right here by Nassim Nicholas Taleb. And essentially what it is talking about is anti-fragile are things that gain from disorder. They have a positive sensitivity to volatility, meaning the more crazy things are, the more money you make, and asymmetric payoff. An asymmetric payoff is when you can make a lot more than what you can lose. A symmetrical payoff would just be a 1-to-1 risk-reward ratio. Now, essentially what we're doing with this type of theory is it is the anti-prospect theory. For those that don't know, I want to show you something that you probably have done or know about but just don't know the name of. It's called prospect theory, and it was invented by psychologists Kahneman and Tversky. Look at the top right that you have right here on the screen. This is essentially what prospect theory is. So imagine that you have $1,000 and you have two options with this, potential $1,000. You can either get a 50% probability of making $1,000 or a 50% probability of making nothing and you walk away, nothing happens, or you just have a certain $500, wired to your account immediately. Most people will choose option B. It's more human. It's the safer thing. It's guaranteed money. Why wouldn't you want it? And that's just what people tend to do. However, here's where things get really interesting. Now it's the opposite. You have $2,000. There's a 50% probability of you losing $1,000 and a 50% probability of you losing nothing. Or you could take the 100% probability of losing exactly 500. Now, when it comes to losing, I don't know about you guys, but just my human instinct, speaking of losing, look at this. Oh, Bitcoin's tanking. I love it. Great timing. I think me and most people would probably go with option A. You're taking a gamble, a risk to either lose nothing or to lose $1,000 versus a guaranteed loss of 500. This is prospect theory. And what anti-fragile does is it looks to make money from people that are using prospect theory. So that's why I would call it the anti-prospect theory. So what is essentially anti-fragile? And why is it important to us? Well, what we want to do with our economic strategy is we want to protect our downside, but not only that, we want to also basically benefit massively from any crazy negative event or positive event, and in all cases avoid fragility. Now, for this take that I have right here, what we want to be doing is using an anti-fragile scale. Now, what I mean by that is how fragile is our account. So one would be these strategies are incredibly fragile, meaning the percent chance of you losing losing your account essentially is likely over 99% if you continue to perform these strategies. 100 means it's incredibly anti-fragile. Now that means really means both things, okay? Something that's very anti-fragile means that you're likely not gonna lose everything. Not only that, it also means that you benefit from disorder. So 1 means that you benefit from nothing happening really, just not much happening, and you are doing a strategy that's quite risky, okay? So there's 2 tiers to anti-fragile that I want you to understand, okay? And if something's very anti-fragile, it has basically 2 requirements. 1, it has to benefit from an uncertainty, and 2, it can't risk your entire account. Let's get in. Most trading techniques, of course, can be found in the middle. What is fragile on the 0 to 100? Well, 20x leverage and below, no stop loss. It's going to be quite fragile. I gave it a 25 out of 100 because it's pretty risky. Another thing that people don't really understand just how risky it truly is grid trading with no risk control. Very, very, very risky strategy. Because if you don't have a stop loss and you are grid trading, meaning you're putting limit orders all over the place, eventually one day you're going to lose everything. 20x leverage and above with a stop loss, this is a bit safer. But because you have a stop loss, so the chances of you losing your entire account in a trade or two is not as likely because you're risk managed, but there is a chance that you could lose everything. So that's why I gave it a 32. Now, stat arb, I gave a 45. For those that do not know what stat arb is, it's essentially if you take the US stock market and Bitcoin or Bitcoin and gold, whatever 2 assets you want, and you essentially trade the correlation between these 2 assets. I might short the US stock market and then, the SPY. Then I might go long Bitcoin futures. That could be one thing that I could do in order to take a stat arb. Okay? And then we have funding rate arbitrage, which isn't really too fragile, meaning it's likely not going to lose your entire account, but it could potentially happen. Funding rate arbitrage is when, let's say you can buy a coin that has a negative 2% funding rate and short a coin that has a negative 1% funding rate, and you take profit and stop losses to risk manage both assets on different exchanges. That's funding rate arbitrage. It's not the riskiest thing ever. It's really not too risky, but it does carry some risk for sure. Now here's the fun part. Let's get into the very fragile stuff that if you do this stuff, it's quite likely you're going to lose everything. This is fun because this is really the crux of this whole thing. Over 500x leverage, it might be obvious or not, but this is the riskiest strategy known to man. If you use anywhere over 500 times leverage with no stop loss and just for the vibes, essentially, I would say it's about probably a 99% chance of losing everything. The more you do it, probably around 99, maybe a bit higher. That's why I gave it a 1. This is the most fragile strategy out there. Not only does it risk your entire account, it gets hurt from uncertainty. If you continue to do these trades, maybe once you benefit from uncertainty because, I don't know, let's say you short 500x leverage, right? And price tanks, you're technically betting, you're gaining from that, crazy asymmetrical move and that uncertain move, but at the end of the day, it's not going to work out. You're probably going to lose everything. High leverage scalping, about 50 times leverage on average. No stop loss, again, very risky. That's why I gave it a 5, which is pretty scary and pretty bad. Martingale DCA, I have been guilty of this. I know you have been guilty of this if you've ever traded perps, perpetual futures in Bitcoin or any altcoin. Martingale DCA combo, essentially what it is let's say that you initiate a 2x leverage position on a $1,000 account and you have a $2,000 short. Price goes up a little bit on Bitcoin, you short more. You now have a 4,000, which is 4x leverage. Then price goes up a little bit more, you double down again and you martingale, and you've been at some point you have a $32,000 short position because you just keep doubling and then eventually you lose it all. That's called martingale, dollar cost average perp trading, just trying to get to break even. Incredibly risky. No, it's not as risky as just high leverage scalping, active leverage all at once, 50x and good luck. It's not that risky, but it is very, very risky. Okay. Binary options trading is something that I think most people should know by now or likely do know. Now, binary options are basically you get a binary payout of you lose the money you put in or you make, 80% of the money you would have lost. Not the greatest trades of all time, but they're pretty risky. Shorting near expiration options is incredibly risky just by the name of it. It's essentially what you're doing is you're benefiting from short-term time decay, which is going to decay quite rapidly, making you decent returns quite rapidly. At the same time, because you're on high leverage, any move against you in that options trade, if you short a put and price goes down, or if you short a call and price goes up, you're screwed, essentially. And you're going to lose everything in your account, making it very, very, very fragile. Okay? Buying meme coins is also very, very, very fragile, but it's really not as fragile as I would say, massive leverage trading because you're trading spot, you're not trading on any margin. But at the same time, the assets are so speculative that it becomes a derivative in itself because it just has so much risk. Let's go to the anti-fragile because these are strategies that I will say tend to be better. They tend to not risk your entire account. Not only do they not risk your entire account, these are types of strategies that will start to benefit from chaos. Stop loss hunting. This one was a little bit complicated for me to put. Stop loss hunting is when you put limit orders right below lows, limit orders right above highs, stuff like that, to try to capture stop losses and then a quick reversal. It kind of benefits from uncertainty, a lot of wicks all over the place. But at the end of the day, it's not really that anti-fragile. It's not really going to benefit from crazy uncertainty. It'll be hurt. So it's kind of like middle ground, Standard trend trading was also kind of hard for me to place where does it benefit from chaos or is it hurt by chaos? It's kind of in the middle, I would say. If there's a present trend, I would say it's a little bit more anti-fragile to be trading that trend rather than counter trading that trend. However, you're not really benefiting from that much volatility or from that much chaos if you just trend trade, with spot or with very, very low leverage futures. So it's kind of like somewhere in the middle. In the money, options trading is riskier than you might think. That's when you buy an option that is in the money. And if you do that, you can actually be risking a substantial portion of your account. For example, if you buy, a 90 delta option, which has a 90% chance of expiring in the money, and you use your entire account to buy it, let's say no leverage, you just throw it all in, there's a 10% chance that you could lose everything in your account. Not by like liquidation or anything, but just by that option expiring out of the money. And that's what can happen when you buy in the money. So yes, it can benefit a bit from disorder because you're longing an option. That's why I put it at 64 out of 100. But it's not really benefiting that much from disorder, just a little bit because volatility does come into play. So it benefits a bit from things going crazy. Spot arbitrage is, again, a little bit more complicated because does it benefit from chaos? Is it hurt by chaos? Is it safe for your account? When I put spot arbitrage, I'm making the assumption that you're not using your entire bankroll to perform an arbitrage. Spot arbitrage, guys, is when you see two mispriced spot assets, you buy one, send it to the other exchange, and then you sell it on that exchange. Now, it does benefit from some disorder because you need disorder in order to do spot arbitrage a lot of the time. You need some type of fluctuation. So it does benefit from disorder, but at the end of the day, it really doesn't benefit that much from craziness and things all over the place. Just a little bit. Things that really benefit from disorder are the very anti-fragile. Basis trading definitely 100% benefits from things going crazy. What basis trading is, for those that do not know, is essentially you are trading a future against a spot asset and you're using them to margin against one another. Very easy example. Trade I'm in right now, actually. I'm short 1.5 Bitcoin and I am long 1.5 Bitcoin. I benefit from the spread between those two assets going in my favor, essentially. This tends to be a very safe strategy because your spot margins your futures. So it's not too risky, and it does benefit from things going crazy because let's say that you go long basis, and you would have to be in the Discord to kind of understand a little bit of this theory, but we're going to get to that. Let's say that you long basis, you really do want chaos. If things just kind of stay normal, you're probably not going to make or lose anything. So breakout trading. Very, very good recently. I mean, look at all these potential breakouts right here. You can kind of already see them. Yeah, this does benefit from disorder. That's why I gave it an 85% to how anti-fragile it is, because it really benefits from disorder. What benefits even more from disorder? Yeah, strangles and straddles. For those that don't know options, this is just when you buy a call and a put at the same exact strike price on the same expiration option chain. Okay, this will benefit from things going wild. Now, the reason I put it at 92 instead of like an 100, well, it's going to benefit from disorder, but it takes a lot of risk. Let me explain. It takes a lot of upfront capital to buy a straddle or a strangle because you're buying a call and a put. Typically, it's around at the money. You got to pay a lot of money. So it benefits from things going crazy, sure, but there's a high upfront cost, which kind of draws it down a little bit. So that's why. Now, the second most anti-fragile strategy possible that absolutely just benefits from chaos and disorder and things going crazy is breakout trading min-tick. Min-tick breakout trading, you can do this in really any market, but I think in crypto it probably works a bit better. Breakout trading with a one-tick stop loss, the risk is almost nothing. Because if you get hit in a breakout trade and then you have a one-tick stop loss, you're not going to lose that much money. However, on the flip side, you benefit from a crazy asymmetry because you could do this with 100 to 1 risk reward, which is why it is so anti-fragile. Let me show you a really quick example of a trade that anyone could have taken. You could have taken, really, anyone could have taken that could benefit from this. Yeah, it was right here. The move below $50,000 on Bitcoin right here. So if you see right here, this is just crazy volatility and price did not recover. So once price went down out of this channel right here, it just did not go back up. So that kind of min-tick strategy would have paid off quite well, and that would have been great. There is one strategy, only one strategy that will make more money in these kinds of scenarios than that. And that is far out of the money options trading. This is called buying tail risk. When I say far out of the money, I mean very out of the money options. So for those that don't know, when you long an out of the money options trade, options asset, options, call put, you're going to make money only if there is chaos. You're not going to lose that much money if there isn't. That's why it's very anti-fragile, because the upfront cost is really cheap because it's so unlikely that the event will happen. But if you buy these and the event does happen, then you can make a lot of money that way. An easy example, imagine that you had an option expiring, let's say August 5th, August 6th for a put. That means that we want price to fall if we long put. Now, when you do this when price was 65,000 and you buy a 50,000 put that's expiring in like a few days. The price of that might be like $5 or less. So let's say you load up on 100 and get really lucky. Yeah, you're going to make a substantial amount of money from that. Your upfront cost is only, let's say 100 times 500. Let's say your bankroll is like 10 grand or 20 grand. And the event did happen. Price tanked, as you can see. These contracts would be worth a lot of money. Now, if you want to know just how much these contracts would have been worth if you had bought 100 at 5, and at this point in time, how much they would have been worth, well, right here, they would have been worth a little over $1,000. So if you had bought 100, your position would be worth about $100,000 just from a $500 cost. That is why buying far out of the money options is very, very, very anti-fragile. Okay. Now, with all this being said, if you liked what I have talked about today with strategies that are fragile, likely to lose your entire account, and anti-fragile, likely to lose you money in the short term, but then eventually make you a lot of money, then I think you'd really like my BTC Hangout Pass Gold. With that, happy trading. I would highly, highly recommend that you go check out this book. And I'm really happy that I was able to apply all this to crypto and get this to you guys on time. With that, happy trading and always be anti-fragile.